The silver market has quietly become one of the most controversial corners of global finance, and as we move deeper into 2026, it is increasingly discussed not just among traders, but in analyst circles where price forecasts range from modest gains to dramatic spikes. Silver historically has two identities: a precious metal, often lumped with gold as a hedge, and an indispensable industrial commodity, used in everything from solar panels to 5G infrastructure. That dual identity means its price dynamics cannot be understood by a single narrative. As of early 2026, silver prices are trading well above levels seen just a few years earlier. The metal's value climbed sharply in 2025 as investors sought refuge from geopolitical turmoil and expectations of future inflation. Prices that once languished below $30 per ounce less than a decade ago have seen extended rallies, at times approaching and retracting near the low triple digits. This volatility reflects both real demand shifts and the peculiar structure of silver markets, where paper trading, futures contracts, and physical holdings interact. Within those markets, exchange mechanisms like the COMEX and the London Bullion Association dominate price discovery. Futures markets allow traders to take positions on silver without necessarily taking physical delivery, and during periods of extreme demand, this has led to tensions between paper and physical markets. At times, premiums for physical silver in certain regions have risen above the benchmark paper price, a signal that the supply of deliverable metal is tighter than it appears on exchange books. Analysts who examine warehouse stocks and deliverable inventories have noted multi-year lows in registered stocks, raising questions about how much readily available physical metal remains compared to the volume of outstanding futures contracts. This dynamic is a fertile ground for the narrative that exchanges are somehow obscuring the true price of silver, but it is essential to differentiate between structural complexity and deliberate suppression. Market infrastructure simply reflects the fact that many participants trade for short-term gains, hedging, and speculative purposes, while physical demand continues to grow on longer time horizons. Forecasts about where silver might trade by 2026 vary widely. Mainstream institutional models from large financial firms often place silver below $100 per ounce, reflecting expectations of normalization after periods of heightened volatility. These projections incorporate traditional macroeconomic factors such as interest rate expectations, currency movements, and industrial demand trends. However, some analysts propose scenarios in which silver could surge much higher, with outlier forecasts suggesting prices as high as $250 to $400 per ounce by the end of the year. Such projections are typically contingent on a set of conditions that include continued deficits in production versus consumption, rapid acceleration in industrial usage, and financial market stress that drives investors toward tangible assets. A closer look at supply and demand fundamentals reveals a persistent structural imbalance. Silver mine production has struggled to keep pace with global consumption, and above-ground inventories that once offered a cushion have been drawn down as both industrial users and investors accumulate metal. Solar PV installations, electric vehicles, and broader electrification trends have incrementally increased industrial demand, a factor often underappreciated in narratives focused solely on silver as an investment hedge. This industrial backbone supports a long-term bullish case, independent of short-term trading flows and futures positioning. Nevertheless, industrial demand alone is insufficient to push prices into quadruple figures without coincident financial market catalysts. Another piece of this puzzle is the role of safe haven demand. When macroeconomic uncertainty rises, whether due to geopolitical conflict, trade disruptions, or unexpected shifts in monetary policy, precious metals often become attractive to investors seeking alternatives to equities or fiat currencies. Silver, like gold, benefits from this dynamic, though it tends to exhibit greater price swings because of its smaller market size and greater sensitivity to liquidity flows. In periods when traders anticipate central bank rate cuts, the opportunity cost of holding non-yielding assets falls, potentially bolstering interest in precious metals. The combination of lower rates, heightened risk perception, and structural supply shortages can amplify price moves beyond what standard regression models would suggest. Stories about price suppression or masking often reference the prevalence of paper positions far exceeding physical metal. While it is true that the volume of futures contracts can be many times greater than the amount of silver held in exchange warehouses, this is not unique to silver. Similar dynamics exist in other commodities where financial instruments dominate liquid exchanges. The critical point is that these instruments facilitate speculation and hedging, but they do not by themselves determine long-term price trends. Physical fundamentals, supply, demand, inventories, and real economic usage ultimately anchor sustained price movements. Nonetheless, abrupt dislocations between paper prices and physical availability can create stress points in the market, prompting some traders to argue that exchanges understate true scarcity, an argument that remains contested. The hypothesis that exchanges are hiding a $400 price by 2026 interprets market signals through a lens that assumes both deliberate orchestration and significant hidden demand. In reality, most institutional research acknowledges the possibility of sharp upward moves, but frames them as low-probability, high-impact scenarios rather than baseline expectations. For silver to breach $400 per ounce in a sustained way, a convergence of supply shocks, explosive adoption in industrial sectors, and major financial repositioning would likely be required. Central banks reallocating reserves into silver, rapid exit of silver leases by major holders, or breakdowns in futures settlement norms are among the hypothetical triggers that could drive extreme upward pressure. Yet these are not reflected in standard forecasting models used by large asset managers. On the other side of the argument, risks remain that could cap silver prices or induce retracements. Higher mining output, recycling of silver scrap, adjustments in industrial processes to reduce silver usage, and the return of risk appetite to equities can all blunt upward momentum. Additionally, if macroeconomic conditions stabilize without significant inflationary pressure, safe haven demand could recede, leaving silver more exposed to cyclical trends rather than structural demand growth. These counterforces are part of why diversified forecasts exist, and why market participants often hedge their assumptions rather than rely solely on extreme price outcomes. In the context of U.S. investors, understanding silver's dual identity as both a commodity and a monetary metal is crucial. Futures, ETFs, physical bullion, and mining stocks each reflect exposure to different aspects of the market. Prices reported on exchanges are products of both aggregated expectations and concrete transactions, and while narratives about takeovers or clandestine price ceilings capture attention, rigorous analysis places such narratives within a broader set of economic forces. As 2026 unfolds, monitoring inventory levels, industrial demand trends, monetary policy shifts, and geopolitical risk factors will provide the most reliable signals of where silver might be headed. Whether the metal ultimately approaches $400 per ounce or settles within more moderate ranges, the interplay between market mechanics and real-world fundamentals will remain the defining story of silver's evolution in global markets.